2020. As the agenda shows, we're going to go through our review of the year so far, which I hope you already feel we have covered extensively through our now twice weekly commentaries, increased due to the unprecedented nature of the crisis. And we hope you find that our general comments we make are on a timely basis. We will include our investment solutions, how they have performed during the short term and over the long term. Then we will look at the disciplines needed to invest over these unprecedented times. Then we'll pause and look at any questions you may have. On that point, please feel free to ask questions as you go along. There's a comment chat bar at the bottom. If I miss anything, please don't hesitate to contact your advisor and I'll answer any questions in due course. So that takes us through to the review of 2020. What has happened and how did we perform? In the previous quarter, we talked about the speed in which optimism turned into pessimism by the rising risks of a recession. This was, of course, an explanation of the tail end of 2018 and the beginning of 2019. The reverse played out last year, and we ended with optimism front and centre. The CNN Fear and Greed Index stood at 93 on the 9th of January 9th of January this year, 100 being the maximum score for extreme level of greed. As optimism fed back into the markets, we felt a prudent stance was more appropriate. We moved the main series of our portfolios to a marginally underweight position in equities in Q4 2019, and our newly launched multi-asset blend funds were launched with a more cautious weighting than their neutral positions. Whilst we did not expect the pandemic that struck the world, we were expecting an increase in volatility. What we did witness was something extreme, as the coronavirus brought about the quickest bear market in history. As you see here at the top, that identifies how quick it's taken from the market to go from peak down to trough. It just took 16 trading days for a drop of more than 25%. And the bear market is well and truly upon us. It's ended the record-making bear market for the US and the globe, and we'll show you some more headlines later on in the presentation. But if we overlay the market here, you can see from the peak to the trough, that was just 16 days and came in at minus 25%. Extremely quick, extremely fast reaction. Let's put this into context. Here we have a chart of the past 16 drawdowns in the US market, the S&P 500, and it shows drawdowns of more than 15%. It shows the magnitude of that drop. It also shows the months it took to get to the peak. So here, and then the months from peak to trough. But interestingly, how long it took to get back to the previous high. Firstly, look at one we're currently in, is the quickest drop on record. We already know that. Secondly, the average time it takes to get back to the previous peak is 7 months. There are some obvious exceptions. If we look here, 49. More recently for us, the last two recessions, big recessions in 2008, which was the dot-com crisis, and 2007 to 2009, which was the global financial crisis. They're the notable exception. They take 39 to 34 months accordingly. We don't know what the outcome is going to be on this. We're going to look forward on our outlook, what's going to happen, but this just gives an indication of what's happened in the past. So that's the markets. If we look at economies now, you can see here the typical length of a recession, and we're definitely going to be in recession. That's 2 consecutive quarters of negative growth. Q1 was locked in, and we expect Q2 to do the same, and we'll show you what our route out of that is well. The average length of recession here is 13 months. The obvious exception here, 43 months here in 1929, that was the Great Depression. Now, the most recent one we've had here is 2007, the global financial crisis, or the Great Recession. And the reason we didn't end up with a situation same as here was the difference being here was the speed in which the global policymakers around the world, that's the central banks and the governments, increased liquidity into marketplace. That's where we've got quantitative easing was the first time that was introduced, and the amount of money that was produced there. If we put those two together, we now have a situation where you can see, although economies and markets are very different, you can see that stock markets tend to anticipate the trough of the economy, typically 3 months before the economy troughs. So we're looking at a situation where we're hoping the economy echoes what we're doing here, and we're trying to call where the bottom of the market is. Typically, you have to see a 30% drop. We haven't seen that yet. We're going to go through what our expectations are for the markets going forward. It's definitely going to be a lot more volatility. But that was the quarter. How did we perform during that 3-month period? And you can see here our model portfolios. Blue are our active range and grey our enhanced passive range. Firstly, it was a negative quarter. That's no hiding from that. We're going to put some context in that with some of the benchmarks that we use. And you can see here, the higher risk you've taken, the more you've lost. In the lower risk portfolios, passive seem to have done extremely well, but as you go up the risk scale, our active is pretty much matching the passive. If we look at the benchmarks now, and we use the ARC benchmarks, they are a typical indicator of what the wealth management industry is doing. If we look at the Sterling Cautious benchmark, and this is measured for our portfolios 1 and 2, you can see there, even though we had a negative quarter, we actually did outperform, apart from portfolio 2 in active here, we did outperform the benchmark. So that wasn't too bad. If we go on to the Sterling Balanced, which we measure against portfolios 3 and 4, again, even though it's a negative quarter, we did outperform the benchmark, losing less than our peers. Steady Growth is benchmarked against portfolios 5 and 6. And again, the same pattern. A gap there, reflecting our outperformance. And finally, the last one is Sterling Equity Risk, which is measured against portfolios 7 to 10. Again, levels of outperformance. So even though it was a negative quarter, we have managed to soften the blow on that downturn, and based on these indicators, outperformed a lot of our peer group, which we're really pleased to get. Interestingly, though, the FTSE 100 is used pretty much as a bellwether for this. Over the quarter, that first quarter, it returned minus 24%. You'd have a line somewhere along here. I could draw a bit straighter, and you can see significant outperformance in the FTSE 100. So although it was a negative quarter, we did outperform the benchmark. And that allows us then hopefully to have a head start when we get to the recovery phase. But we'll talk about that later when we look at the macro outlook beyond. Again, if you have any questions, please don't hesitate to type them through. We have the ethical portfolios, our cautious, balanced, and ethical growth. Again, negative quarter. Again, the more risk you take in, the more you lost in that period. But we're going to use the same benchmarks against here to see how we've performed on a relative basis. Slightly underperformed cautious. The steady growth is where balance is measured against, and a significant outperformance there. And equity risk is what ethical growth is measured against, and again a significant outperformance there. So the same story for our active and enhanced passive portfolios through the ethical portfolios. It was a negative quarter. We're not immune to these movements. We are long-term investors, but we managed to lose less than the markets. Just a reflection on what, before we go to our long-term returns, what the market looked like during that period. And as I highlighted before, on the 9th of January, start this year, the index of fear and greed was at 93. CNN used 7 different metrics in the financial system to indicate what the buying patterns are. Are people exhibiting greed or exhibiting fear? At the height of the market, on the 19th of February, it had gone back to more of a neutral reading. And you can see a very precipitous drop to the bottom of the market on the 23rd of March. We have a reading of 5 extreme fear. So you can see how quickly that swung across. And during those periods, the reading was extremely volatile, and we're still sitting in extremely volatile periods. So this is overlaying the actual indices, the MSCI World, and where the indicators are. So this was the 9th of January here. This was the height of the market on the 19th of February, and you can see the drop down there to the 5th. We have seen a bounce up in that last week in March. Our current reading now is 45. That's fluctuated between roughly 38 and 47 at the moment, and we do use a lot of indicators and forecasts to help us come up with numbers. We'll go through those longer term numbers in a moment. And this is the long term reading for the Fear and Greed Index. And what I want to draw here is parallels here. This low indicating reading here that we saw on the 23rd of March, it reflects what we were seeing here at the end of 2018. Don't forget, the end of 2018, we had those readings because the risks of a recession were imminent. They got covered off by central banks acting extremely quickly, and you can see the recovery here. Echoing that, we can see the recovery here. The difference being, at this point here, we are now hitting a recession. I can see some people typing. I hope they are coming up. I can't see any questions yet, but if you do have some, please don't hesitate to send them through. That takes us through to our long-term portfolio returns. We'll go through active first. These are the active portfolios, been going for the longest, going over 15 years. And you can see here, they keep within their boundaries. So portfolio 1 does better, does slightly less than 2, 2 does less than 3. So it's about managing that risk. And you can see there was a drop off here. We can see how that's affected the long-term numbers. The gold bars represent what the return has been over the portfolio since launch without the ups and downs. You can see portfolio 5 here, as this is 131.56% return. You can see they go up in line with the risk, so you're being rewarded for the amount of risk you're being taken over the long term, which is really important. We measure that against now cash, inflation, and the FTSE 100. So you can see every portfolio indicating cash here has outperformed cash over this 15-year period. So you're better off investing in these portfolios than you would have been, say, for example, I'm saying putting with the bank. Inflation, roughly 50% over that period here. So all the portfolios, bar portfolio 1, increased your purchasing power. Because inflation, if you're not beating inflation, can erode the amount that your money is worth over the longer periods. And the FTSE 100 here dropped down significantly. Portfolios 4 and above have outperformed FTSE 100. Interestingly though, if you take these figures over 5 years, so this is over 15, but if you take a 5-year figure to the end of March 2020, every single portfolio in active, that's 1 to 10. Every single portfolio in enhanced passive, that's 1 to 10. Every single portfolio in ethical, that's cautious, balanced and growth. Every single portfolio in income, that's sustainable and high, have beat FTSE 100 over that 5-year period. The FTSE 100 over 5 years has just returned 2.91%. So that 5-year period, every single one of our portfolios has outperformed. If you include inflation over the top of this, and you'll see in some of the charts, inflation is extremely high compared to some of the portfolios. Here we have 15 years. We measure it here and you go across. You can see here, over 15 years and a bit, inflation is going to erode the purchasing power by over 25%. That's why you need to be invested over the long term, not only to be your purchasing power. If you invested for 40 years and you didn't inflation and you just had it in cash, returning nothing, that £100,000 would be down to 44.5. Sorry, the question just came through there. So that's active. These are the enhanced passive portfolios. We can do a similar exercise here. The enhanced passive has now been going for 7 years. And you can see the performance is the same. Risk managed throughout the portfolios, portfolios 1, portfolios 2. We bring in the gold bars to show you the total returns over that period, and then again compare against cash, inflation, RPI. And here, interestingly, you can see that although all the portfolios have beaten cash, which is great, the FTSE 100 over that 7-year period has not beat inflation. So for all the portfolios, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 have beaten the FTSE 100 over that period, and portfolios 2, 10 have also beat inflation. You can see actively managed, whether it's a passive or an active vehicle, so actively managing the actual underlying investments in strategic allocation and tactical allocation has done extremely well. These are our income portfolios. Again, they've done extremely similar. We're going through our income propositions and looking at that more closely. Sorry, just had a question coming through. Bear with me one moment. Just saying, if this presentation does run beyond 11 o'clock, we obviously will pause for 1 minute for the key workers, but we should finish before then. So that's the comparison of income portfolios against the FTSE 100 cash and RPI. And the income portfolios now have been running 9+ years. They'll be running 10 years in November. And you can see here, they have outperformed both FTSE 100 cash and inflation. And if you see, FTSE 100 over 9+ years has failed to outperform cash. It continues to outperform inflation. Even though it's a bellwether for a lot of people's investments, having a diversified portfolio is definitely the way to go. If you invested income, you want to be looking at the amount of income being generated. You can see here, these are what you're going to get from the high street. Nationwide down to 0.1. Post office down to 0.24. ICI Bank still advertising 0.12, but their websites, they're going to reduce that. So I imagine that's going to come down extremely quickly. If you're going to borrow to the government for 5 years, they're going to give you an annual return of 0.17. That's the price of having potentially a risk-free asset. So if you expect the government not to default on their interest payments. Interestingly, for 30 years, it's down to 0.68. 6 months ago, when we did this presentation, 30-year return coming in at 1.17%. It's almost halved over that period. So you can see why a lot of borrowings coming through at the moment. It's extremely it's extremely cheap for the government to actually raise its debt at this moment in time. And finally, with ethical. Ethical is now 5 years old. So we've got 5-year level returns in here, and you can see conformably how they've done. We'll bring in the gold bars again for the performance, and again over this period. Cash, every portfolio beating cash, every portfolio beating the FTSE 100, and this, because it's over 5 years, this reading for the FTSE 100, that's the reading, which is 2.91% over the last 5-year period, and beating inflation. So all the portfolios performing still extremely well over the long term. We do expect a lot more volatility going forward. Which brings us to our outlook, what we think is going to happen. I had a question from Peter. Peter, the FTSE has been lackluster. How do we look against the Dow? I haven't compared against the Dow. I can provide some figures for that. I'll send them through to the advisors so they can distribute them. Dow being a sort of favorite list of the top 30 stocks in the US. I'll provide the same comparison against the Dow for you as well. I would expect it to have done well. Obviously, there's going to be some currency coming into play because the FTSE is our home currency, but I will do those figures. Thank you, Peter. That's a really good question. So we look going forward, what do you think is going to happen? I'm going to use 3 examples. We've got Ed Sheeran here, we've got Taylor Swift here, and for those with a bit of a long enough memory, that is Frankie Goes to Hollywood. They're going to explain the macro outlook going forward. So Ed Sheeran did a song called Shape of You. This is the world index up to the 16th of April, and everyone's trying to guess what the pattern return is going forward. For the first time, we did here, is the return going to be a Nike swoosh? That's the first time I've heard that. That's not in our base case. A U-shaped recovery. We certainly haven't had a U-shaped recovery. We've already had a sharp uptick from that bottom on the 23rd. It was expected to potentially be a elongated U for the market. Interestingly, though, rather than the market, a U-shape is expected for the economy. We're going to see this downward pressure as the economy has been shut effectively with lockdowns and businesses having to close down. We expect that to last over the first 2 quarters. Then you expect it to potentially bottom out over Q3 and hopefully increase as policymakers help to bridge that gap, as vaccines start to appear, as we get some economic activity resuming. That's pretty much the base case for recovery, based on a lot of fiscal and monetary support. What we have seen so far is this V-shaped recovery. It was expected from a lot of things. It fell as quickly as it did. The monetary response, we're going to see some headlines in a moment, has been extremely quick. We'll cover that off in a moment. But going forward, is the V going to continue up? That is the question mark on everyone's lips. We don't think so. One of the explanations is we're going to get a square root. It's just going to flatten off now as the market looks to anticipate what the economic recovery is going to look like. For us, though, W is our favorite one of our base case, where we can expect to see some downsides in the volatility extremely high. What sort of factors would cause this W pattern? Contagion affecting large percentage of the populations, but shutdowns ultimately successful in flattening the epidemic curve. That's where you're going to get another uplift. It's making sure the healthcare systems aren't overwhelmed. The draconian measures prove initially successful in stemming contagion, but there is the risk of a second wave as quarantines are lifted. Global supply chains, risk appetite, and consumer business sentiment is dented and a bit slow to recover. Then we might think there's a short-term pent-up demand. We'll go through it in a moment. But ultimately, the massive fiscal and monetary responses do allow for another sharp uptick. If you look at the global financial crisis, the one we had before, there were lots of V's in here, but ultimately they mostly turned into W's. So it's about making sure we're not tricked or fooled into this is done and dusted now. We think there's a lot of volatility still left in the market. That's why we're still cautious in our outlook, but we have been prudently taking steps to increase our exposure, particularly in our multi-asset blend funds, which being daily traded are more nimble in this market environment. So that's the shape of you. We now move on to Taylor Swift, who did a song, Everything Has Changed. And you can see here, the global monetary response, this is from the central banks, has been absolutely huge. The ECB, European Central Bank, 750 billion of bond buying. The Bank of England confirming unlimited QE, unlimited purchasing power. Interest rate cuts to 0, the Federal Reserve, to 0.1 for ourselves in the Bank of England. And these measures were brought in extremely quickly. If you think about quantitative easing back in 2008, that took over 2 months to be brought into play. This has taken literally a week for them to come through. So the speed of response has been extremely encouraging, and the amount of kitchen sinks being thrown at this has helped underpin the market. And we saw it this week. We had a market that had the first negative weekly return in April, although we had an uptick the last day in February. We saw another 484 billion stimulus package signed off by Donald Trump, the 4th stimulus package since this epidemic came into place. What we're seeing is a marketplace that if we do get some volatility, another amount of stimulus package is going to go forward. And it's not just stimulus, it's the fiscal package as well. So governments have to step up with their spending plan. We've had our own new chancellor with 350 billion kiss of life, it says here in the headlines. That's 330 billion of loans and 20 billion of direct stimulus. Don't forget, when we initially launched, it was only going to be 20 billion. Suddenly increased 10, 11, 12-fold. Germany with some increases last week as well. It's around the world a concerted, coordinated stimulus, economic stimulus to go through. And if you read the quarterly review that has now been issued, we give some explanations what a fiscal stimulus should look like, what a monetary stimulus should look like, and when you combine them, what an economic stimulus should look like. Why have we had these stimulus packages? Why have so many kitchen sinks been thrown at the problem? There's two phases. In phase one, it's about stemming that initial drop in demand as economies are being deliberately shut down in the lockdowns. It's shutting these down. You want phase one to potentially be as short as possible, as this will dictate arguably how long the recovery will be, which is phase two. And it's this balancing act between lowering economic activity in order to lower the spread in the infection, in order to protect the world's health services. There's a very difficult balancing act, and everyone has got a part to play ensuring that they keep the systems in place and keep the health services intact. But what you're doing, you're deliberately shutting down economic activity. Phase two, that's about will the economy bounce back. The crisis won't last forever, but the fallout from phase one will mean there will be some job losses and there will be businesses collapsing. And it's making sure that through fiscal packages, through monetary packages, that liquidity and money is easy to access. So the businesses that should survive are able to survive, and unemployment is kept to a minimum. Because it's about keeping the unemployment low as possible, because the employed, when they go back to work, they're the ones that are going to drive the growth. They're going to drive the economy. You want to try and keep unemployment low as possible in order to make sure the recovery is as quick and as strong as possible. But everything has changed. Consumers' habits have changed. The way we consume, has this accelerated the shift to online? When I'm sitting at home, number of delivery trucks is immense. Not all to our house, I'd hasten to add. And the way we work, this presentation is coming through clickmeeting.com. This is something we would have been doing face-to-face, so I do look forward to seeing you all at the next face-to-face seminar, whenever that will be. But we're now able to present these presentations online, and hopefully they come across clearly as well. And it's about us working remotely and flexible. If you look back to the Olympics in 2012, the amount of home working spiked during the summer as people wished to watch the Olympics at home. But when the Olympics finished, that dropped to a level that was higher than before. It'll be interesting to see if that plateau goes up again as people realise they can work efficiently and effectively remotely from home. And the way we leisure as well, is that going to change? When barriers are open and borders are open and lockdown comes down, are people going to want to travel abroad? How are they going to use their leisure time will have changed differently. And demand in the long term and the short term, how has that changed? And if we look at technical disruption, because technology has helped us get through a lot of this situation, then you can see in the previous chart, Netflix and Disney Plus, the way we consume content has massively changed. But how long does it take to get 50 million users? Why has this moment, this crisis, enabled us to get through it seemingly easier than it would have been previously? If you take airlines as technology, that took 68 years for 50 million users. It took a long time to adapt to this new technology. Roll forward to automobiles, telephone, electricity, credit cards, television, 22 years to get to 50 million viewers. You can see as new technologies come in, new way of working coming quicker and quicker, it's easy to dismiss this speed of change. And it gets to a more rapid pace. So the most recent one done was for Pokemon Go, and that came in 2016. How long did that reach to get to 50 million users? 19 days, just 19 days. And the augmented reality behind this app, even though it's a game, has actually been used for some more serious applications, including education, photography, astronomy, and health as well. So this is why new technology, Zoom, Microsoft Teams, Click Meeting, Netflix, Disney, all these things, we're more used to able to adopt these new technologies. And finally, we were talking about unemployment. It's about making sure that there is a pent-up demand, and unemployment is key to this. And this is the US jobless claims throughout history on a weekly basis. You can see, below 1 million here. and we had this huge spike up to 7 million. There's cumulatively been 22.6 million additional unemployment registers in the US. Now, why is that different? We're going to move now on to Frankie Goes to Hollywood, and I've taken a bit of artistic license here. This is about the demand conundrum, and it's from Two Tribes. In Two Tribes Go to War, money is all you can store. And it's about this lockdown has meant people saving. They're spending less, and it's about having this pent-up demand. So when the lockdown comes through, will there be a pent-up demand? We think in the short term, there will be a pent-up demand, but it's will that go through to the long term? Now, the interesting thing here with unemployment, if you look at European furloughing, that is about governments supporting 80% of the income. So they're at home, they've still got a job, but they're receiving 80% of their income, potentially not using it. You know, we're sitting at home now, we're not traveling as much. Lunch is a lot more cheaper because you're making sandwiches at home, necessarily going out to the shops. In the US, though, in order to receive the furloughing benefit, you have to sign on as unemployed, and you get unemployment benefit. And it's the enhancement in the unemployment benefit that is the way they receive their furloughing income. Hence why you've seen a huge spike in the level of unemployment numbers. That's why you're going to see a difference between arguably the unemployment in Europe and the unemployment in the US. And it's making sure this does equate up to this pent-up demand. So that's why we think there's a W. You're going to have this V shape here that we've had, and then you're going to people unlock, and you're going to drop down in the other pent-up demand short term. Going forward there, we just think there's still a lot more volatility. So this is what the governments, the economists around the world are trying to work out. Will there be a short pent-up demand? And what will it be through? You know, are people sitting at home going, actually, I'm fed up with this sofa now. I need to replace this, or I need to get a new car, or whatever. So it's an interesting situation. Now, if we weren't talking about the coronavirus, what we would have been talking about at this moment in time is the US presidential election, or arguably Brexit. But Brexit seems to have definitely taken a backseat during this period. And what we've seen for this first half of the year, arguably, it's all going to be about the virus. However, come the summer months, we think it's all going to be about votes. So another V word, as the US election presidential campaign goes into full swing. It may have missed some people, but during the Easter, Bernie Sanders dropped out of the race. It looks like it's going to be Joe Biden against Donald Trump. And interestingly, we thought a more radical candidate, such as Bernie Sanders, was going to give Trump an easier ride in the US election. A more moderate candidate, such as Joe Biden, is going to be a really close race, we think. But the one thing we know Donald will want going into this is a strong economy. Hence, why you're seeing a lot of fiscal and a lot of monetary stimulus being pumped into the system. There's no more kitchen sinks that will be thrown at this, you can imagine. So expect more stimulus to try and boost the economy. So when they go into voting booths, it's going to be strong for Donald Trump. Had another question in from Jane. Thank you, Jane. Now that we've exited the EU, do you think the markets will dip when the transitional negotiations start up again? That's a very good question. It depends when those negotiations are going to start. Hidden in one of the 5:30 updates a couple of weeks ago, Brexit was mentioned, and it was literally just brushed off into the corner. It's something that they're not looking at closely at this moment in time. It's all about solving the coronavirus. It'll be interesting to see when it happens. The market will always look for the next thing to be concerned about. Obviously, it's been given manna from heaven in terms of the virus, the US election. So yes, I think once the epidemic has been solved and the US elections out of the way, I think then the next thing they'll probably look at is the Brexit negotiations. But don't forget, over the last 12 years, there's always something the markets are looking at, and that's why you have something called the wall of worry to climb back. Because there's always something to make the market volatile. It'll be interesting to see if we come out of this better than the EU. We might end up in a stronger position. But excellent question. Thank you, Jen. So that's the review of 2020 so far and the macro outlook, how it's going to be. Obviously, I would recommend reading our quarterly review for more in-depth analysis. And obviously, we write a Monday morning commentary as well as a Thursday update as well. So if you're not receiving those, please ask your advisor to pass those on. What we're going to look at now is it's called Keep on Track. It's those disciplines to allow us to be invested over long periods of time, or as we like to say, our long-term investing. Some of these charts may be familiar, but it's probably a prudent and appropriate time to remind ourselves what we should be doing in these moments of unprecedented volatility. So first of all, we're going to look at the FTSE 100. This is over 20 years, and it's about investing £10,000. So from 1998 to 2020. Before we go on to this chart, Kevin, question: how many years before we see steep inflation, and based on what critical assumption on how this enormous increase in national debt will be paid for? That's a very good question. The flip side of solving this coronavirus seems to be a massive increase in debt. With interest rates and growth so low, there's one argument we're going to see a small amount of inflation, but not a huge amount because growth is still going to be stymied. But any inflation is probably what the government are looking for. Don't forget, back in 2008, 2009, the reason why we had quantitative easing and this increasing in purchasing assets and money printing was to avoid the opposite, was to avoid deflation. We didn't want to end up in a situation such as Japan. Inflation will erode the value of the debt, but there's no consensus that we're going to get a huge amount of spike inflation that we saw, say, in the late 70s. But it's something that we're going to look forward for, look towards and keep an eye on. The debt will be paid for because we're at historic lows. So if we look, these debts will be written over sort of 15 and 30 years at 0.68% return. And there's some institutions that have to buy this level of debt, such as pension funds and insurance companies have to buy long-term government debt because it underpins what their assets are doing. So the cost of running that debt shouldn't be as onerous as it would have been in the past when interest, gilts were paying 5-6%. So the affordability will be there, but the amount in the debt will be with us for a long time, and it's going to probably be similar to sort of echoing something like the Second World War when we had war loans, and it was only over the last recent years the last war gilt was paid off by the government. So these are going to be long-standing debts for a long time. And talking of long time, if you did invest 10,000 into the FTSE All-Share 20 years ago and stayed invested, that would have given you £31,350. However, if you tried to time the markets, this is about just staying invested, not being coerced, being shocked, being scared into moving your money around, trying to miss the downturns. If you missed just the best 10 days, that return would have halved, 15,504. If you missed 15 days, you still made a profit, 12,447, but it only took 25 days, missing 25 days, to have lost more money than you put in, and that's less than 1% of your return. And that's the pattern you'd have had to experience. So you had a downturn pretty much at the beginning. This is the end of the tech bubble. Then you had the global financial crisis here, and bit of a wobble as China looked like it was going to have a hard landing. So that was the journey you took. So there was plenty of opportunities for the market to try and spook you of trying to time. But if you didn't time the market, you had that guaranteed return of 3 times your money. And it's always been this way. This is a 300-year chart for the FTSE 100, and it just shows you there's been plenty of opportunities. But if you stay invested for the long term, I'm not suggesting 300 years, but this is not a new phenomenon. Volatility has been with us for a considerably long period of time. If you look at the FTSE 100 now, and this is showing you the 15 largest single-day potential losses in the FTSE 100 since 1987, and then subsequent returns over 3, 5, and 10 years later. So if you look at the largest one here, and this was on Black Monday for the FTSE 100 in 1987, a drop of roughly 12% in that single day, but over 3 years, 5 years, and 10 years, subsequent outperformance. So you can see, even though we have experienced some volatility over the short time periods, we believe investors remain committed Their long-term investment plan will continue to be rewarded over longer periods. Obviously, these are no guarantees, but history does teach us, history does rhyme, that's Mark Twain, that you're better off the longer you can invest for, the probability lies in your favour. If we look at buying and holding, so market, an investor trying to time the market. So on the blue line, this is in the S&P 500 since 1936, investing $100. What they returned through buy and hold, and then the study here by Clearbridge, what they did, they worked out and said over history, typical investor tends to come out 10 months before the peak because the news of increasing risk permeates the market, so they come out early, and then ironically they come in 10 months too late. And if you do that study, you can see if you stayed invested, if you try to time the market and move 10 months either side of the peak and the trough, your return still healthy. You would have turned $10 into 8,848. But if you stayed invested, that return would have been 29,340. So probability plays in your favor. Stay invested, stay the course, stay the investment plan that your advisor has put together. And bear market shouldn't be feared. This is again the S&P since 1928, showing you this is the Great Depression. It's some really poor handwriting. Over the 1930s, but you can see 39% of the time you are looking at bear markets, which means 61% of the time you're looking at markets that significantly go up. And if you can be an investment program that softens the blow during bear markets and allows you to get a head start in the bull markets, then it's about not fearing the bear. That's the key. Longer term investors, you're going to have some rocky rides. You're going to have volatility being in your favor. This is what my daughter calls the measles chart. This is showing the FTSE All Share since 1986. And you can see there's 34 calendar years here, 34 calendar years. And probability on the plus side, 24 years. And that's 70%. So 70% of the time, if you invest every calendar year, you're going to have a positive year. So your probability is putting you in favor. However, what we have is a marketplace that likes to test your resilience, wants you to capitulate. And if we overlay the dots here, these are the measles. This is what's going to give you this point of capitulation. This is the low point of the FTSE All Share in that calendar year. So if you take 1987, for example, 4% return over that calendar year, if you stayed invested for the entire period. Of course, we did have a huge market drop in October 87. Not only did we have the storms, but we had Black Monday as well. And the low point, minus 37. This is your point of capitulation. So minus 37, you could have come out and gone, wow, this is just too volatile. However, if you stayed invested, you would have had a return of 4% for the year, even though you got to that point. You can see for every year, there are always points much lower than the returns. Last year, at one point, minus 8% for the FTSE All Share, but ended up with a positive return. What we have here talking about positive returns is how often in our model portfolio do we provide you a positive return. And we're looking at our active portfolios because they've got the longest return period. And if you invested just for a quarter, your return would have been positive 71% of the time. Fantastic. That's where a marketplace, they're looking at maybe just doing 50-50 at best. If you increase that to a 1 year period, you're almost up to nearly 80%. 3 years, 86, and 5 years, 99% of the time, you would receive the positive return. There is one rolling 5-year period for one risk profile that produced a slightly negative return. But these are great numbers. If you overlay that with a study done by Goldman Sachs, you can see here that the 1 year number here was the same, 79%, which is great. However, their study to get to 89 took 5 years, Well, we only took 3 years to get to that level. And for 99 stroke 100, it took them 15 years. It only took us 5. They're doing extremely better. And it's about just staying invested. The human need to feel like you're doing something is really powerful. So while long-term investing does sound like a course of inaction, it is important to remember to review your investment plan regularly and decide if action is appropriate or necessary. This placates the need to do something. And of course, inaction, deciding not to do something, should always also be viewed as a positive action. And if you are staying invested, this is the silver lining. It means when the bounce happens, you are going to capture all of it, 100% of that bounce. If you just miss 2 days, and if you go back to something like the turn in the end of 2018, which was Christmas Eve, 2 days later, if you missed the bottom by 2 days, you're losing 10% of that potential return, which is huge. And the same could be said here, that massive V-shaped return we saw in March, 23rd of March as well. If you miss just after a month, and don't forget in the study done by Clearbridge, it was 10 months, but if you miss the bottom just a month, that's almost a quarter of your return you're missing. So it's just about staying invested, be comfortable with volatility, know that the odds of probability in your favor, and then you are looking better. Now, before we get to Q&A, we had another question come through. So, hi Jane, thank you again for another question. What would your advice be for people looking to try this year and draw down a pension? That is an exceptionally good question. So I'm going to take us to a whiteboard now. And what we do suggest is for people drawing down. Forgive me if you've already heard this analogy. It's called larder, fridge, and freezer. So you have your larder here. You have your tall standing fridge here. And we call it a chest freezer. Here. And you want to split your income up, your assets up. And in the larder, depending on your attitude to risk, depending on the amount of income that you need, depending on the financial plan that you've done with your financial advisor, you look into somewhere between 1 and 3 years worth of income. So you work out your expenditure, do your cash flow analysis, work how much income you want to put into the larder here. Then in the fridge, you have a medium-term investment. And we would recommend something like one of our income plans. And that goes in the fridge. And what that's going to do, the income portfolio is going to be generating natural levels of income that they're going to fill up in the fridge, as well as having the investment in there as well. And when you're reviewing your portfolio, you might take some of this income and refill the larder up. And in the freezer, this is your long-term investment. And that might be in one of the enhanced passive active growth portfolios. It might be one of the active growth portfolios. And it probably has a higher level of risk. Let's say, for argument's sake, something like a 7 or 8. Because when you take all of this into consideration as a combination, having cash, having some income, that's going to reduce your portfolio down. And at moments of profit, you might take something out of the freezer to defrost into the larder to replenish what's in the fridge, and then take the income in the fridge. So it's making sure, if we go back to the presentation, making sure you have sufficient income available for the next 1 to 2, 3 years. So you're able to not have to eat into the long-term assets at times of volatility. Hopefully that made sense. While we're here on the Q&A point, I'd just like to say a big thank you for everyone who's dialed into this webinar, and hopefully you found it both informative and useful. Thank you for the comments we've received during the webinar. We look forward to answer those that weren't able to do it during the presentation. If we missed any question, or you think of one later this afternoon, please email your advisor and we'll get back to you. So we've got to come back on the Dow question on those charts. Before we get to the formal Q&A part, big thanks to everyone who's helped with this webinar together. There's a lot of people behind the scenes that make this run smoothly as possible. So please put through some more questions while we go through this. Just before we answer some more, you see some people are typing. In case you didn't know, last year in the Money Marketing Awards 2019, we won Best Discretionary Fund Manager, which we were really pleased of. That was extremely good accolade to receive. We've actually also been nominated this year with the Best Discretionary Fund Manager. So really pleased, really pleased. Just it's the proof of the pudding of our process and what we do. On top of that, we've also been nominated for Best Passive Manager as well for our enhanced passive product. So really pleased to be recognised for that. So that's really good. So that is our compliance slide. Really important information there that you might want to read. Don't forget this is being recorded as well, so you'll be able to review that at your leisure. So thank you for attending. There will be a replay available to view if you want to go through this again, if once wasn't enough punishment. But now time to answer some questions. So please type away. I'll leave this open for a few moments because I'm a bit conscious that 11 o'clock is on us. So if you do have any questions, please type away and I'll allow myself to have a sip of water. So rather than leave a stony silence on the presentation, I will draw this presentation to close. If you think of any questions in the meantime, please don't hesitate to ask your advisors and then make sure they follow through. Just going to wait one moment as I can see some people are typing. Just want to make sure that can come through. Thank you for your attention. We'll be running these on a regular basis, and I really do look forward to seeing you at the next one. Kevin, another question, thank you. With Trump's trade war against China, how much does the COVID crisis further reduce the value of investments invested in China? Or does the China early exit mean investment should be increased in China? That's a really good question. China market has already bounced extremely well. Interestingly, we're looking at the first investments into the China bond market. They're going to be a significant player in there. Some of our globally emerging market investments will have some exposure to China. They're definitely one to keep an eye on. Whether we have a discrete investment in China at this moment in time for equities, that's probably a little bit way off, but I think China's come off this extremely well. And again, no mention of China. The blueprint in our argument has moved from how China has handled this, and there was a really good article in the Weekend FT about Wuhan and how that's looking now. Looking how probably US is probably now the epicenter of what the blueprint's going to be. There's an argument that China have got a handle of it. We've got a personal friend who is a teacher out in China, and we had a lockdown memoir there. They're in like day 98 of being locked down, and some normality is starting to creep into the marketplace. So, China will be interesting. We looked initially at coal consumption because that was the measure of increasing use of electricity as people went from the rural areas back to the urban areas after the Chinese New Year. And as that consumption increased, we were looking to not see an increase in infections, and that's happened. So arguably, we think China's probably got a handle on this. If it's something you want us to cover a little bit more detail next time, we will. Final question. Thanks for the presentation. Over the next 6 to 12 months, which your portfolios are most confident capture the gains and outperform? It purely depends on your level of risk. We think all the portfolios will capture an element of the portfolio. Obviously, the ones with the higher level of risk will get more on the upside, but conversely, the ones with a higher level of risk will obviously participate more in the downside. And finally, would a W recovery be sensible to take 5 years plus? We think the amount of resource being thrown at this problem, a recovery will be quicker than it has done in the past. But we still think increased volatility is here to stay, but hopefully in a more upward movement. Bit conscious that we're close to our minute silence coming up at 11 o'clock. Thank you for those questions at the end. That was really useful. Really appreciate that. If you've got any others, please put them forward. But I'd just like to say thank you to everyone. Please keep safe. Please keep well. And I look forward to either doing this again online or seeing you in the flesh. Thank you very much. Bye-bye.